Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast, Open Mic Night. I am your co host, Chris 70, flying solo again tonight as Gail Greenberg is literally flying right now back to her homeland of Pennsylvania. So, is tonight's episode based on feedback from all of you out there. We're going to talk about the top 5 mistakes I see investors making currently when bidding on assets. So with that being said, before we start, just want to kind of get back to what just happened. So for me right now, one of the things that I've been working on is converting CFDs to notes, and the whole conversion process, it's a lot more intriguing and challenging than I thought it was going to be. And I'm in the process of trying to wrap up some of a first round of getting those done. So we're going to have on in the future some people who specialize in this, because there's different ways to do it in regards to just issuing a quick claim deed. But once you start getting into the warranty deeds, things get a lot more complex and more complex than I thought. So I've been working that process. And what I found interesting is when I'm speaking with the borrowers on this and kind of explaining it to them, the first question they pose back to me is, what's the catch? Because they're wondering, like, okay, why are you doing this when every other seller would never offer this and so forth? So they're always wondering what the benefit is. And things I've been telling them are, it's both parties' mutual interest. You've been paying on the property for many years, and I prefer to be a lender, not a property owner. Once you start explaining that to them and explaining that you're not a large bank and some of the benefits, most of the time they're ecstatic to actually get it back put in their name. So that's just one of many, many things that I've got going on, but kind of just wanted to mention it because I am going to be sharing a lot more in regards to that, because it's a very interesting process and I am learning a ton from it, which again, I'll take that information that I learned and of course, and share it out to all of you. So with that, let's get rolling with the top 5 mistakes I see note investors making right now on bidding on assets. And start with number 5, which is getting seller expectations. And this is important because what you don't want to do is waste your time on looking at the tape if the expectations just completely aren't there. A perfect example is earlier today, there was a tape that was published, and I've seen this tape in the past, and I know the expectations are just so very high expectations by the seller, and it's something that does not fit any of my criteria for where I'd want to be paying for assets. So, there's 100 assets on that tape where you could spend 4, 8+ hours on that thing, going through assets and maybe looking at things and trying to put in bids or however much time you'd spend. But once you go through it and realize that their expectations are just so overly dramatic when they're wanting 80% of the total payoff, or the higher of the payoff, or the fair market value. It's just not there. Example I remember on the tape was there's an asset worth $200,000 and the payoff was like 160, and they wanted like 150,000 for it. And I was like, that's, there's no money in that. And their comment was, well, you're going to make 50 grand because you're going to get it foreclosure. And my comment was, well, if it's really worth 200,000, somebody's going to bid more than a payoff, and the most I can collect is the payoff. And they were trying to tell me, no, that's not the case. Even if the payoff was 40,000, even in property is worth 200, you would still get the property back at foreclosure. So that's what they were trying to sell me on. And it was a joke, to be honest. And it's a waste of time on some of these assets that you see. So it's always good to know who the seller is, or at least get their expectations, because if the expectations aren't in line with your business plan and structure, then it's not worth wasting your time or their time. And Christina, I don't know if that was a tape that was sent out. If that person sent it was sent out by somebody else, I'll just leave it with that. And so forth. But I did not get that tape that you're referring to there. So, and Sylvia, you're exactly correct. Properties that have so much equity, you're not going to get them at foreclosure for the payoff. If a property has a payoff of 50,000 and it's worth 150, 200,000, you're not getting it back, or it's really not worth 150 to 200,000. So it's one or the other. A lot of times you're happy. I mean, for me, if I can get total payoff, I'm ecstatic. But I'm not going to pay 80-90% of total payoff because there's no skin in that game. So that's one of the things that I start with, because a lot of people, and that I fell prey to this when I started investing. I was just like so ecstatic to get tapes from anybody or anything. It's kind of like being that geeky sophomore kid in high school wanting to go on a date, and it's like anybody that will go on a date with you would be like, hey, I'll go on the date. Kind of like feel like that when you get tapes when you start out, and so you just look at everything. But a lot of times what you'll find is your time and effort could be better focused on different things. So that's first thing, is the seller expectations. So second thing that kind of plays off into that is what I really just touched about, is bidding off payoff versus UPB. I don't know really in any instance. I know for a fact I don't think I've ever bid above UPB on an asset. I would consider bidding close to UPB if their payoff was extremely high. But one of the things that when sellers look for that, I've always posed the question is, are you guaranteeing that payoff? And they look at you like, I have 6 heads. And, with a UPB, there's a pay history that shows, that being paid. So that is something that's pretty much, guaranteed. It's typically very rarely disputed, or it's easy to, distinguish what that is. Payoff is a whole nother animal. Because there's certain things like, taxes, and you have to provide copies. If it gets contested, you have to show that you've paid it, and then you may have to chase other borrowers down. There's forced place insurance. And then in certain states, there are certain costs that are and are not recoverable. Ohio has quirky laws for things like that. So, I see people who will look to and bid off of the payoff versus UPB. And I would say, that's a mistake. You can take it into consideration that taxes may have not been paid for 3 years and so forth, but you got to be very, very careful. And again, I'll refer back to that tape I saw today, where they wanted you basically to bid off of payoff, and in most of those instances, you're going to be paying well above UPB, and it's you're going to have to potentially eventually confirm all of those costs, and think of the time and effort you're going to have to do if it ever gets contested, of trying to chase down every bill and chase down prior servicers for that. So that's a lot of time and effort that's going to have to be put out there. So. I don't understand your comment there, Sylvia. So, that's the second item, bidding off, payoff to UPB. The next one I will mention is loans that have low principal and interest payments, but high UPB, in that instance. So there could be loans that have a $30,000 UPB, and the payment might be $250 a month because it might have an ultra low interest rate. And I'll see people just randomly pay 80 cents, 75 cents on the dollar for that. And, do the math, that 30,000 at, call it 80 cents on the dollar, is 24,000. if the principal and interest is in the 200s, you know, after servicing, you're getting about $2,400 a year. And eventually it would take you about 10 years to get your money back. So, it's make sure when you bid, you're really looking at um, you know, the yield or how long it takes to get your money back versus, just looking at the UPB and flat out bidding at, 75 or 80 cents on the dollar, because that can come back to bite you. I've seen in many instances, I remember some tapes where Paul Burkett, Automation Finance, who just put out a $50 million, or just noted he has a $50 million Reg A plus fund. I bought assets from Paul in the past, and I enjoy, I view him as a good seller to get assets from. But sometimes he's got some stuff that is a little hairy. AHP is another one that kind of, some of their loans have high UPVs with low principal and interest payments, and just be careful. And when I see those types of loans, typically I'll just pass, because I try and look to get my money back in 3 to 5 years. And when you look at a loan that you're netting $200 a month, that's 5 years is 12,000 on a $30,000 UPB on a performing asset. Is the seller basically going to take a what's that, 40%, an asset at 40 cents on the dollar when it's performing? Typically they don't, because they think of the same thing of, hey, look, I want to get 70, 80 cents on this thing. And when you're offering 40, that's almost in non-performing range. But if you actually valued it from a yield perspective, what they're looking for, the yield would be very, very low. So does that make sense for people? So, okay, good. So those are 3 of the items. So we talk about the low principal and interest, the bidding off payoff. And another item is, basically as part of bidding, and it's really more, I'll say, kind of these 2 items roll a little bit more into due diligence, is, checking, well, actually it's due diligence, but bidding is part of bidding. I like to check taxes, and, checking taxes is important, because sometimes the borrower or seller may put what the taxes are, and, a lot of times they can be wrong. Now, in some instances, it's not easily available online, and you may have to pick up the phone and make a phone call. So it takes a little bit of effort. Now, I'd say the same thing of, actually I'll roll into that as the next one. But, the other component too is also, sometimes secondary liens, or understanding the area or the structure as part of the tax program. I had an instance actually just yesterday, and this was a note that I had bought, maybe about 2 years ago, and it's actually in bankruptcy. And the borrower's attorney sent me a letter and basically said, hey, look, the taxes haven't been paid in 3 years. The borrower got a letter saying that they have to go to court. So kind of caught me off guard, because I went on, Madison's portal, and, we've been collecting escrow and paying the taxes. But what we found is there are city taxes and county taxes. And that's an important question to ask, that I've learned, is from doing due diligence, bidding an asset and just calling the taxes. I'll ask the question and say, are you the only tax authority? Pennsylvania, you've got the county, you've got school, you've got, tax you for the air in Pennsylvania. So, it's a question to ask, and the people are very friendly and they'll help you. And in this instance, I didn't, do that. So kind of caught me off guard. And, I called the attorney and basically, was very friendly with them, and just said, hey, look, I apologize. When it was escrowed, when I looked at the escrow payment versus the forced place insurance and the taxes, the number was pretty close to what was being carried. And this other tax, which was only $250 a year, so it wasn't a huge, it's not thousands. it got missed. And I said, I apologize. Let the borrowers know I'm sorry. I'm sure they got freaked out when they get a letter in the mail, saying they got to go to court, because I know if it happened to me, I'd be freaking out. So I said, let them know we'll get it taken care of. And, it's in bankruptcy. So we'll work on getting it added to the escrow, whatever it is, but just let them know we'll get it taken care of. And I'll reply back to you once I confirm the check goes out the door. And the legal aid for the attorney was like, thank you very much, and it's very kind of you and polite to basically treat it and not be adversarial in any way, shape, or form. It was, hey, it was a mistake that happened. And basically it was because when I had called taxes 2 years ago, I forgot to ask the question. So it's something that I highly recommend. Along with that is also finding if there is municipal liens as well, is part of the bid strategy. In Northwest Indiana, Lake County, sometimes you get water sewer liens or other type of liens that can stick. Try and just get as much information, if you're calling a tax person, as possible. Like, okay, is there the water department or someone else I can call to see. And the last kind of roll into the next one is, if you're making those calls, find out if the power is on, find out if the water's turned on. Just ask the question. The reason I say that is, again, you're spending time doing this bids, and you get a bid under agreement. Then you're going to start spending money having a BPO and O&E report and all this stuff done. And if the property's vacant and water's been turned off for 4 years, wasn't it worth a 5-minute phone call to the water department just confirming that the water was on? Versus spending 135 bucks on an O&E report and 100 bucks on a BPO. It's kind of, I know a lot of people don't like to do that up front, or may not just like to make the phone call, or just kind of do that extra step. But I'll tell you, it can save you a ton. And I'll share information, for example, of some of the recent pools that we acquired. And picked up the phone and was calling as part of the bidding, you know basically because the seller wanted me to take the whole pool. And I just did some spot checking on certain ones, because they provided O&E reports, and ones that had some tax balances I would call and so forth and ask and stuff. And there were some that had liens of over 100,000 on the properties. So I wasn't even wasting my time, and I was just telling the seller right up front, hey, just take these back. I already made the phone calls, and there's no use putting them on the list for me to punt them later. Just, tell you right now, just take them back now. And, they're like, okay, thanks. And they're, when you explain to a seller, $20,000 UPB, $40,000 property with $100,000 in liens, he's like, yeah, of course you're not going to buy it. You'd be a fool to. So, sorry, I got to get my water. So those are some of the some of the things that I see. Those are kind of the top five. And now I'll throw in some bonus content, because some other things recently just popped in my head, which are the understanding your expenses. And a calculator, and I love my calculator, but we use the term in real estate, garbage in, garbage out. What you put in, if you put garbage into it, you're going to get garbage out of it. And the reality of it is, you're trying to forecast something that you can't predict. But if you're aware of what the expenses could be, then you can evaluate your risk. And from that perspective, understand what state you're dealing with, what jurisdiction you're dealing with, and understand the costs. Don't try and find an attorney or find this stuff out after the fact and just throw a dart at something. It's get information from an attorney, or talk to somebody who's done a lot in that state. One thing I see a lot of people doing is just and I posted this in the group earlier, is taking advice from people on Facebook. And I love the bigger pockets posts from people saying, hey, I've got $250,000, how should I invest it? and you've got 30 people basically saying, asking the question the day before, understand, what's ROI stand for, but then replying back to this person, hey, why don't you invest in me? I've got this great real estate deal. Same thing with people asking for tax and legal advice on things. It's there's experts in that for a reason, and that's who you should use. Similar to, is your bidding strategy and understanding the risks involved. Not only is it understanding the costs that are associated with, potential asset and foreclosure, but what are the risks involved as well? And what I mean by that is, if the borrower contests, is there mediation, or what happens in that case? That's something, could that delay? How long could the delay be? You want to understand those things, because you can read online, USFN, US, I think I forget what it stands for, US Foreclosure Network, I believe, usfn.org. For like $30 you can buy an awesome you know brochure from them that basically lists the state timelines and kind of a little summary for each state of the steps for foreclosure. And I highly recommend people go out and pay the 30 or $40, whatever that is, usfn.org, to get it. You can learn a ton, but again, that doesn't tell the full story. A lot of times, sometimes if you send the demand letter or the complaint and they respond within 30 days, what does that happen? Those are kind of conversations you just want to have with the attorney. And, a lot of times you get that from experience, from that perspective. But again, back to bidding, the more questions you can ask, the better in that sense. And kind of my second bonus item in regards to bidding is understanding risk. There's, you want, a risk adjusted weighted return is kind of a phrase we use a lot, in my full-time job. And what that means is, how much risk are you willing to take on for a specific return? I've had conversations with people before on this, which is, people talk about, doing JV deals on non-performing assets of giving 12 to 15%. And, if I called you up tomorrow and said, hey, look, I can give you 10% on a partial that you put in 20,000, I'll cut you a payment of $500 a month for the next X months. And, basically there's $50,000 left on the loan, property's worth 200,000. So you've got a 10% equity position, making 10%, on your money, or go to a JV deal on a note in Ohio, is an example, my favorite state, where you're going to try and target, 12 to 15% to the investor. What would you rather do? Would you rather have many sleepless nights trying to get 12 to 15%, or get the 10%? And again, on a $20,000 investment, say it's a 12-month time frame, for example, 10% is 2,000, 15% is 3,000. What's that $1,000 worth to you? And from that perspective, is $1,000 really worth that much risk? That's the things you need to evaluate as well. And I know a lot of people, as they get started out, really just want to push to the non-performing. But sometimes, when you look at things, sometimes you're better off underperforming or buying a partial from someone because of, that. And, when people talk about, buying performing assets from 12 to 15%, on JV deals, you tell people, hey, I'm going to try and get you 12, 15%. Sometimes you scratch your head. Why are you going through that risk? And the other component you have with the risk is, who are you giving that money to? You want to make sure who that person is, what's their experience, make sure they don't walk away with it, make sure they can pick up, they understand how, when these things work, hello, you got to use these things once in a while. So, I know a lot of people are always, looking for that lottery ticket asset. But, I'll ask everyone out there, who's bought a lot of notes and stuff, how many of those grand slams do you get? It's far and few in between. And does it happen? Of course it does. But you're not going to be hitting, 30, 40, 50% of your assets are going to be hitting grand slams. If you are, then let me know, because I'm just going to give you all my money to invest from that perspective, and I'll go sit on the couch. So, so those, to me, are some of the things I am looking at right now. People have questions or feedback or other comments, be happy to take them. I do see some questions pop up right now. First one from Owen asking, is there a way during due diligence to determine if a CFD is a good candidate for transforming into a mortgage? Yeah, if they're paying. A consistent pay stream for me, they've got to have at least 24 months of consistent payments. Because of, if not, then again, you're looking at going through a whole foreclosure process versus a forfeiture, again, depending on the state. But it's going to be a very, very solid borrower to do that conversion. So that's one of the things. I wouldn't do it as part of a modification or anything. It's I have done like 3 or 4 already, but those were quit claim deed over to borrowers. The ones I'm doing right now, I'm trying to get title insurance policies on them, and it's a whole nother animal. It's and I'm still going through a lot of the hiccups, the bumps in the road, and it's interesting working with title companies and kind of their thought process on things. I'm very close, but not yet at the point where I'm really able to share the full story. But that is going to be coming out. So. Let's see. Sylvia mentioned saw a loan, said been bought for an HOA amount, so that there was a loan, a second, and therefore the first was still in place. Save selling. It was in Florida. Sound right? So an HOA lien basically still owes the first. You got to be careful. In certain states, there's they have what call it like super majority, where an HOA can strip the first. And in Florida, I think recent law has new originated loans after a certain date, I believe can. But older liens, yeah. So what happens a lot of times, what you'll see investors do, which is actually pretty creative, they'll buy the HOA lien from the HOA. So say it's like a $10,000, they'll give them like $2,000 for it. And what they'll do is they'll turn around and foreclose on it, and then they'll put a renter in there. And they'll just collect the rents, and their whole game plan is hoping that it's like a major institution or a lender who just constantly ignores and doesn't foreclose. And what they'll do is they'll just keep the renter in there, and they know it's going to take a year plus in Florida to foreclose. So say they buy the lien for a few $100 and they spend $3, $4, $5,000 to foreclose, they're in it, 5, 6,000. They might be getting $1,000 a month in rent. So they'll roll that thing for a year to 2 years. And then when the lender finally comes back and says, I want it back, or takes it back from them or forecloses on them, they're like, okay, go ahead. I've made my money, from that aspect, because technically they take ownership of it, but again, it's still subject to the first lien on that. So, yep. And see other notes about people. One of the things they like to do with JVs is trying to learn from individuals. That is another aspect of the JV deal. But one of the things that I've come to the realization is on JV deals, it is very difficult to train people. You can try and keep them in the loop on a lot of things and so forth, but a lot of times things happen very quickly, and sometimes it's kind of more like going back and it's like a history class of taking what's happened and explaining it to them. To do it live, I find very difficult, and I don't think there is a perfect way to do that. One of the things that I think has been beneficial for people is in the fund that I have, we do training within the fund. And this past week I did an hour webinar with people before we did our fund update, and we were doing due diligence where we pulled out 4 or 5 title reports and I sent them out to people early, and it was kind of like a test. I said, hey, find out what's wrong with these uh, reports, and we'll talk about them tonight. And their ONI and the whole collateral, and kind of briefly went through kind of what a collateral package should look like, what's included in it. And sometimes there's 20 pages, sometimes there's 800 pages in a collateral package within it, and then kind of how to read title reports and understand that just don't take what's on the face or cover sheet for as the gospel. Because on the one that 2 of them that I went through, one of them basically was sold at tax sale, which wasn't covered on the cover sheet, and another one had a title defect because deeds were recorded out of order, which again wasn't on the cover sheet. And so it's just because you get an O&E report, just don't read that top line where it says errors or whatever it is on it. Make sure you go through the whole thing. Similar to a BPO, just don't look at the BPO. Look at the pictures, look at everything else that they've provided in there as well. So it's just not you pay people to provide you a report, but it's up to you to make sure that you review, understand it. I look at everything that I have consultants give me. I think of it as my 8-year-old's homework. He's got a job that he's got to go do his division, and I expect him to do it properly because he should know how to do division and so forth. But he'll bring it to me, and I still check it. That's my philosophy. I'd say that my attorneys and others have probably have a little better track record, but at the end of the day, that's what people should think about is with some of these consultants, it's you still need to review their work. What does it cost to convert a CFD to a mortgage? So there's several things involved in that. The first is what type of title are you providing to them? And that could be, if you're doing just a quick claim deed to them, then you basically costs I think $250, create all documents and do a conversion. So that basically can be done for $250. If you want to provide title insurance, you probably got to tack on another $1,000 because you're going to spend $250 for a title report. You're going to spend $400 or $500 for title insurance. Now can you add that to the borrower and so forth? There's certain ways you can have them. You can ask them, hey, if you want title insurance, you got to pay for it. You just got to make sure you can't collect those fees up front. That's a big no-no is conversions, collecting fees up front. Another component is, when you do these conversions, you can't increase the rate or increase their payment either, because it is a conversion. If you start increasing things, then it kicks off a lot of RESPA and TRID stuff. So yes, and I am talking about owner and lender insurance, because typically when you run a title report, you're going to get title insurance from First American. Now you can just get a lender policy, but typically, it's just easier to get both, and it's beneficial, to get both. And for me, I think it adds value to the asset if you can get it with title insurance, but it's left to be seen whether or not it does add that value. But it can fluctuate. It's anywhere from, I've seen people talk to a mortgage company who wanted about $2,000 to do it because they were treating it as a refinance versus a modification. Because really, a conversion from a CFD to a mortgage is actually, it's technically a modification in the mind of an underwriter. Mike asks, is there certain states that you can't do CFDs? Yes, there are. I believe Texas, you can't. But then, I mean, there's other states that you can do them, but there's no benefit. For example, Maryland. Now, this is crazy in Maryland. And in Maryland, with a CFD, if it doesn't get recorded by a certain period of time, and the borrower can come back later, dispute it, and if it gets disputed, basically recoup all the money that they paid. And in most states, if somebody tries to recoup money because of like a loan like this, it's an offset by like a rental provision of, okay, rent would have been this much. In Maryland, my attorney says that's not the case. So, if someone was paying $600 a month for 5 years, and all of a sudden they defaulted and you tried to do something, they, got a wise attorney, they could come back to you for 36,000. That would suck royally, wouldn't it? Florida CFDs are treated like notes. Georgia CFDs take longer than a note to foreclose. There's several other states. Indiana, I think, is much more beneficial of a CFD. Michigan is more beneficial for a CFD. Illinois is more beneficial for a CFD. Pennsylvania can be, but right now Pennsylvania is focused a little bit on CFDs, trying to get people to convert them. So, it's something that with CFDs, you're starting to see, and we've done other podcasts about this, states start to put restrictions on CFDs, and I've realized the reason why is because I like to consider myself an honest lender, but the stuff that I see out there with people putting 30% interest rate, putting a house worth 20,000, putting a CFD for 50,000 on it. I mean, that's just wrong. The other thing I see is people who get CFDs as a borrower turning around and trying to, arbitrage them or put people on lease options underneath them and stuff like that. It's just, sometimes it just feels like the Wild West because, they go somewhat unregulated. So it's, the states are finally starting to catch up a little bit on that. So. You mentioned I'm in Louisiana. I only did mortgages. I have actually, Louisiana is one of the states I have not acquired anything in yet, I believe. As many of you know, I have the goal of trying to acquire an asset in all 50 states. I've recently got a few more check marks on that. I've got one in California, so cha-ching there. I've added one in, Arizona. So cha-ching there. New York, fun. By the way, if anyone's interested in any CFDs, I've got a performing CFD, two performing CFDs, actually no, performing CFD, a performing note, and a non-performing note in New York. If anyone's interested in those, I'm going to be putting out on a tape that I'm going to be, hopefully by the end of the weekend, I'll be putting out a tape for sale for people. So people interested in assets, be putting some stuff out there. I know there's a lot of stuff that came out yesterday and today from a few servicers and so forth as well. But we've been, a little delinquent in getting something out, but I'm trying to get something out this weekend. Okay. So question was asked, what's my main reason for doing these conversions from CFDs to notes? All of the above. So listen to Jamie, you hit the nail on the head. Typically three things. One is resale purposes. I think you'll find a lot more buyers on a note, especially a performing note, than a performing CFD. I think if you get title insurance on it as well, you basically, I look at it as selling pretty much grade A paper. Originated with title insurance and using the FHA mortgage and promissory note docs. It's no different than a bank issuing the loan to this person, in that sense. So that's one. Cleanup title issues, yes. Also sometimes the cleanup title issues. Now just because the title may come back clean, but there could be issues with the contract for deed. Say you were missing an assignment of land contract, or and it's tough to hunt one down. People always get the whole allonge issue with CFDs can be debated for perpetuity. But sometimes when if the CFD is unrecorded and may have a blemish to it, one of the simple things is just convert it to a note or cancel into a new land contract, because you got to remember, from a title insurance company perspective, that's unrecorded. They don't see that. They have no clue that even exists. So they will provide that insurance. So you cancel that and put it under a mortgage note, or the other thing, if it's a CFD issue, you could always cancel a CFD and issue a new one. But at that point in time, it goes to the next component that you talked about, which is the liability of property ownership. And for me, I prefer to be a lender. I mean, granted, I've got a very large portfolio of CFDs, and I don't mind owning them. But in the flip side, perfect example, I got a fax today from a borrower, performing asset, CFD, originating in 2008 in Cleveland. And the individual wants to get a permit to do some work, but he wants to pull a permit, but he's not the property owner. So he wants me to sign a document that says I'm going to be doing all these things. And I'm sitting there like, I'm not signing this. I have no clue like what you're doing, and so forth and so on. And the guy's, well, I want to do this and stuff. And there's like $13,000 left on the balance of the loan. So I basically said, hey, look. And, I pulled up and saw the pay history, and the guy's been paying for 3 years. So I said, at least 3 years, actually. That's as far as I went back, and just stopped. I said, I'll make this easy on you. What if I just convert it and put you on the title and just get rid of this stupid land contract and put it back in your name? And the guy's like, really? You'll do that? I'm like, yeah. I'm like, do you think I want to sign documents on you doing a renovation and take responsibility for you renovating a property? He goes, no. I'm like, exactly. I want to be a lender. So that's another reason. And the other component to it too in Ohio is, after 5 years, they're treated like a note anyway, so you have to foreclose. Which then leads into the whole licensing issue in Ohio, which I'll leave that for another day. And if anyone has physically actually gotten that license, I would love to speak to you, because I keep getting caught up with them on having a qualifying individual have 3 years experience as an MOO, because my company is not a servicing company, and they either put you in a bucket of an originator or servicer. And if you're not servicing, you're an originator, but I don't originate anything, but I don't do the servicing. So I've had this discussion. I'm trying to get in touch with the supervisor to try and come to some conclusion or resolution on it. But my license is just hanging out there pending right now. But I did get my Georgia one, so that's good. Let's see. Or putting them again, Sylvia, I don't understand the question about putting something in junk properties. Okay, Jamie, good. What other questions do people have out there that we can answer for this evening? Excuse me. I'll pose a question to the people listening out there. I'm just curious in regards to, the assets. And I'll be honest, I haven't really bid on anything in the last probably 45 days after I've taken down kind of 2 large pools of assets. We are in the fourth quarter right now. Typically, fourth quarter, you do see a lot more assets. I'm curious to hear from you guys. Is the stuff you're seeing, decent and price decent, or is it kind of bottom of the barrel stuff with a lot of hair on it? One of the interesting things I saw last year at this point in time was I found in October was the best month for assets. When we started the fourth quarter, it seemed like there was a good amount of decent assets at reasonable pricing. And as it got closer to that year end, basically they just regurgitated what was left and were trying to give away a bunch of stuff, but it was truly bottom of the barrel stuff that had a significant amount of hair on it. So I'm curious what people out there are seeing. I see a comment about bottom of the barrel or unreasonable pricing on assets. And I did look at one tape that did come out a few weeks ago, and it was definitely some, much lower quality assets that were on there compared to some of the other stuff. Okay, mentioned seems like an uptick of supply, but bidding a little low apparently. Oh, it's the comment I'll make about bidding is, you got to bid comfortably. And one of the things I was thinking about today, I was going to put this up in the notes and bullets group, was, in a hypothetical situation, if 5 people bought the same note, for $20,000, it was 5 people, basically the same note could be bought by 5 people, at the end of the day, would all 5 people make the same amount of money on that asset? Is kind of the hypothetical I was going to put out to people. And the reason I was going to put that out there was, granted, people always talk about making money on the buy, and it's true to an extent, but you really make money in how you manage your asset. And that's really true in every aspect of real estate. You don't want to overpay for an asset, but really the seller's going to the seller in the market set the price. And if assets are selling it, non-performing at 50 cents on the dollar, then probably not going to get it at 30. But at 50 cents, do you have the skills to manage that asset to make it profitable? And the reality is, many of us do and many of us don't. And like I said, if hypothetically, if you took 5 different people and took 5 different ranges of experience and gave them an asset at the same price, would they all have the same outcome? And that's where the management and kind of the gut comes in, some of these gut decisions. For example, I have an asset in Michigan that is literally in the middle of nowhere. It's a property that is surrounded by pretty much nothing, cornfields. And the borrower had been delinquent he missed like 5 payments. And I, sent the demand letter, and, the guy finally called the servicer, and eventually I spoke to the guy just to try and, short circuit it to, have direct conversation. And the guy, basically said, "Hey, look, I lost my job. I decided to retire, and I was just waiting on Social Security. So that's why I couldn't make the payments." And the guy's like, he laughed. And, the guy, he was a truck driver, and he spoke like a truck driver. And, he's dropping F-bombs into stuff, and was basically saying, "Hey, look, you really don't want this house," and so forth. And I kind of joked with him, and I was, with him, and said, "You're right. Why would I want a house in the middle of nowhere, Michigan, that I basically probably couldn't do anything with?" Which, based on what I paid for it, I could still sell it and get a very good profit on it. But why do I want to throw a guy out of, his house, that, is just waiting on Social Security? And the guy's not going to move. I mean, the guy said he's fixed up the house and done some things to it. But, these are some of the decisions as an investor that get into the gray area of, do you accept the payment or do you not accept the payment? I've got another borrower where, given 2 chances, and then the payoff or the reinstatement was like $3,400, and called in last week to the attorney and said, "I can give you 3,000. Now, do you take it or do you continue to go with the foreclosure?" And there's no right or wrong answer to any of these. It's just that gray area in note investing of there's no right or wrong, decision from a financial standpoint, from a uh, I'll say social impact perspective. Many, including myself, would say, "Hey, look, I want to keep a borrower on a property. I don't want to throw somebody out of a property and so forth, and so on. Especially when they can try and make those payments up. But in the same breath, I also don't want to take $3,000 from somebody, knowing that in 3 months' time they're not going to have any more payments and they're eventually going to lose the house. I'd rather, give them a few bucks to walk away now, keep that money and use it for something else, versus continuing to try and go down that death spiral. So let's see. Question came through about usually creates zone notes, but I'm looking to start buying some. Where's a good place to learn all the strategies and where to buy? So where to buy? I am actually, by Thanksgiving, hoping to roll out some more free goodies and information for everyone who is new, where you'll be able to download a list of, I think is like 20 places where you can buy assets. Good place to learn. This is, a whole nother topic of, another episode about where to learn how to invest in notes in first position. Second position, I think there's, some programs out there that people can definitely take advantage of and learn from. Just last week, we had Bill McCafferty on, who recently launched a training program for seconds and how he manages his business. And I think that can be very valuable, even for people in first, honestly, because I know Bill is very detail oriented in how to manage his business. And, there's a difference between buying notes and running a note business. There's that hurdle that you got to get over to go from one to the other. You got Martin Signs also, doing a lot of trainings on second and stuff. On the first, especially on the non-performing side, there's been issues with, one trainer that I'm not going to get into, but for the most part, a lot of the feedback I've been getting in regards to some of these programs out there, um, that are popping up and stuff or have been around, is it's not very positive. I've heard a few of them may be okay, but then, in the first space, but then they'll push, basically brokered assets to you that are, pretty, pretty horrible assets. So I'll be honest, I think the first space right now is really missing a go-to person in regards to non-performing first. That's my opinion. People have value to their own, but what I have seen, is a lot of investors, who are trying to also get into the training program again, because I'd say, call it the king of training, essentially, and non-performing first, kind of is slowed down a little bit, and there's that opportunity. And I have seen people come up with training, but some of the training that I've seen are people who've bought 5-10 notes, and to me, people who've been in the business a year or two and haven't really bought a lot of notes. Personally, for me, I just don't think they should be training. Just gonna say it like I think. I'm usually not shy to state my opinion on things, but and people have asked me, how come you haven't done training or do training? And for me, it's the time aspect of it. And I'll be honest, if you're very successful in notes and you're doing it very well, you're going to make a lot more money doing notes than you would be on the training. And I think that's a reality of it. And so sometimes I do get a little skeptical with some certain training programs. They're saying they're making all this because there's only so many hours in the day from that perspective. Let's see, and for mentors as well. Again, it really. It's difficult because a lot of the people that you'll find in regards to who've been around for a long time, they're just so busy that they're not really interested in taking the time to do a lot of one-on-one training with people. Gail has done it in the past, some one-on-ones with people. I know she has. Early on, some of the JVs who I've done deals with, I've tried to share as much information and knowledge with them as possible, and so forth. And I still do with many people, but it's just, it's just hard. If anyone knows anybody out there, you know, and so forth. But I'll be also honest with people that I'm not a social butterfly in regards to going to events. I have the podcast and we have this and I have the Facebook group, but I'm not traveling a lot to a lot of these groups because I've got full-time job, I've got family and so forth, and it's just how I allocate my time. So from that perspective, so sometimes I'm just maybe not the best resource, but some free information, I'll tell you, besides, podcasts. I know Rob Hitha at Fixed Notes has a lot of good information for entry level people just getting started as well, because he goes through and has like a whole dictionary of terms, which I think is valuable to have, and things along that as well. Sylvia mentions, I seem to bid very quickly. What are things you do initial DD to get the bids out? So it depends on the seller first, because certain sellers is first come, first serve, and they, I've got a relationship with them that sometimes, basically let them know, hey, I was basing some things off of their tax values if they have them listed, but that comes, I think, with building a relationship with them. Uh, you know, the simplest thing I do is, and I think I've showed people my calculator. A lot of times I don't even, I'll use it sometimes as a cross check, but I'll put in a simple calculation of basically the the UPB. Typically I do, let me see if I can figure it out right now. Roughly take like the sometimes what I'll do is I'll take the P&I, multiply it by 30. And hold on, is that what I do? Yeah, roughly take the principal and interest payment times 30 and see what that's kind of, there's two calculations, but that's kind of one of them. And what that also, does is that's based on basically paying the principal and interest times 12 months divided by 40%. So, that gives me kind of a ballpark range of where the number, sometimes it might be divided by 0.3. So would that be times 12? So take the P&I, multiply between 30 and 40, see where that comes, but also cross-reference that times making sure that it's no more than 40% of the UPB as well. And kind of see where that falls in. And that's kind of the range typically where stuff lands. Again, I can talk all day about my calculator, but at the end of the day, 90% of the time, that's kind of where stuff lands. And that's where I've seen it land within, that variance or that range for the most part. So, so that's kind of, one way. But the other thing too is, when you're bidding on things from a pools perspective, you have to understand, especially if you're taking an entire tape, what is a suitable discount, and just understanding which assets in there are decent and which ones are probably ones that might be throwaways, to discount them to basically a zero to, manage out the portfolio. But basically, like I said, I use data tree. I'll just run down the list of the assets. Typically, I like to acquire the assets where, they're occupied. They've been made a payment on that in the last 6 months, as part of my component, and just kind of know what states and what areas I want to look at. I mean, if I look at a tape and I see, I'm bidding on cherry picking assets, typically Florida, I'm not going to touch because I'm going to get outbid all day long. Texas, if there's stuff, I'm going to get outbid all day long. Certain areas of Indiana, I know there's a buyer out there who just flocks to certain areas of Indiana, and he will outbid me all day long because he's also got a team in place and he can get stuff there. So it's also just understanding not only my capabilities but kind of some of the trends, and over time, the last 3 years, when I bid on stuff, kind of see where I fall into play in regards to pricing on some of these assets. So it takes time. One of the things that I like to tell people too is, it takes, and we mentioned this last week with Bill, it doesn't take 3 to 6 months to get a business up and running. This business takes years. I mean, it's just like any other business. It's going to take you 3 to 5 years to get this thing in a position where you're satisfied. That's like, okay, it's making money. I got my systems in place and it's starting to really follow a path and a strategy. And that all comes with experience. So, a question came through. Oh, two questions. One is get a hold of the list when you put it out. Well, I'll put a link on the Notes and Bolts Facebook group. So, Mike, if you're a member, you'll have it there. But also, I'll send out an email blast to people as well that will basically have it. And from there, and I'm going to mention the links during episodes of the podcast of where you can go to get some of this stuff. Another comment about not being a social butterfly and hard to think a business that is all about networking. So yes and no. I'm looking at right now, the people that are, in this webinar, for example, and, there's a handful of people who I've teamed with and done deals with. And of those, there's several of them I've never met. We've talked on the phone and so forth, and so on. But it's all about building relationships, and networking can be two completely different things. It's just being active sometimes on some social media, and trying to be a respected commentator can go a long way, I think, for people in that sense. Sorry, I have a partner who's actually probably out of everyone the second closest, besides someone else who's on here who lives actually not too far, who I met at for coffee once. But another one basically mentioned that come down for lunch. How about we meet in Perryville, and we'll have lunch up there. But it's like, it really depends on your goals too, in regards to, are you looking to raise funds, or are you looking to invest your own money? If you've got your own money, then you don't need to be a social butterfly. I can tell you, you look at, some of the funds that are out there and stuff, these people, a lot of them aren't really very active at events or some of these other things, because they've already got their systems in place, or their sources and so forth. There comes a point where you're going to have to start networking to get to some sources, but it's not, honestly, you don't have to probably do it constantly. Once you find a source, or maybe you grow a business so you can get a line of credit or something, I don't consider myself, again, a social butterfly, but I try and remain active on social media, just to, make sure people, kind of know who I am. But for me personally, I'd rather honestly have nobody know who I am and kind of just go about my day and do my business. But I do enjoy the podcast as well, though. So, okay. Someone asked, is Rob still selling notes? I don't know the answer to that. I haven't spoken to Rob in a while, so not sure if he is or isn't. He used to represent, I'm trying to think of the name of the USMR. He used to sell a lot of their stuff, but a lot of it was also seconds. you know. So, I haven't seen Rob active recently, but again, I didn't go to, Paper Source. I didn't go to, any of these other events or, network events that people have had going on, or, any mastermind stuff. My focus honestly has been, on my portfolio and, spend my weekends with my family. Any other questions or comments before we wrap up this episode? For those on here, again, thank you for joining us this evening on this episode of the Good Deeds Note Investing podcast. And like I mentioned, when someone asked where can you find assets, my plan is to put out a tape within the next few days and get that out the door to people, so people can have some bidding on some assets. There'll be some performing and non-performing assets on that, some notes, some CFDs. So it's going to be a mixed bag. I haven't decided how many assets I'm going to put out there right now. It's probably going to be about 10 to 15 is what I'm figuring. So I'm not putting out, 50, but put enough out there, give people, something to look at. And, if people want help, looking, kind of understanding or even kind of some of the due diligence on it, shoot me an email, kind of give you the background or rundown on the asset as well. And with that, everybody enjoy the rest of your evening. And as always, go out and do some good deeds. So thank you all.